Good afternoon, ladies and gentlemen. On behalf of MCX and SMP Global Platts, I extend a hearty welcome to each one of you who has joined today's webinar, Evaluating Markets and Risks in 2020 Signals for Base Metals Markets. We have a very distinguished panel of speakers today who will take us through various aspects of commodity markets in general and the risks perceived in these markets now and in the medium term. And we'll also throw some insights to the base metals market. Before we start, I would like to make 2 points to all the attendees. First, we shall take up questions towards the end of the webinar after all the speakers have finished with their presentation. Please use the chat box, which is on the right side of your screen, to type in the questions, and we'll take those questions, as I said, towards the end of the webinar. As far as possible, please mention the name of the speaker who you would want to answer the question that you have raised. The second point is that the webinar is an educational forum where the speakers shall not give any price outlook on any commodity. The views expressed by the speakers are their own, and these views do not necessarily reflect the views of their respective organizations. Now, before I introduce and welcome the speakers, I request Mr. P.S. Reddy, MD and CEO of MCX, to kindly deliver the welcome and the inaugural address.
Thank you, Mr. Devo. Let me welcome at the outset all of you, ladies and gentlemen, for this webinar organized by MCX and in association with Platts. We are grateful to the speakers for agreeing, especially Professor J.R. Verma sir and Ms. Joyce for being with us today to share their thoughts on the topics of their choice in this market. We have chosen the base metals because this is one of the important areas which the MCX has been focusing in the recent past, and SEBI has been helpful in organizing this meeting. In fact, they have encouraged us that you must do something about this kind of webinars. And grateful to SEBI and their senior leadership has really helped us in organizing this program. As you all know, as MCX, we have about 4 verticals: energy, bullion, metals, and agri commodities. It's not just the base metals on which we will be focusing, because the other energy as well as the bullion has been doing well, but at the same time there's a long way to go in those areas also. And we are also looking at index features that we propose to launch very shortly, and we will be looking forward your support in those products as well. And we will be creating as much awareness as we can through the webinar route, so that the members or their clients or any of the constituents and other stakeholders take informed investment decisions when they enter into this market. And my colleague Mr. Ranjan will speak about the developments that the SEBI has ushered in ever since FMC has been merged with SEBI, and the very legal framework has given a great room, much greater room for the SEBI to launch various new products, and risk management system has been strengthened, etc. And then we have today with us Professor J.R. Verma, who has been an acknowledged authority in risk management. He has been guiding the entire capital market reform process in the risk management area for a long time, and we are grateful to him for accepting our invitation and making a presentation today, which is an educational initiative. Grateful to you, sir, for accepting our invitation. We we also acknowledge the support the SMP Global Platts has given, and by sending one of their expert speakers in this area. And we have many others also lined up with SMP Global Platts. And as we go along, we will be unveiling all those initiatives. Thank you once again for joining. And I once again acknowledge the support of the senior team of management of SEBI and other officials. Grateful to all of you. Thank you so much.
Thank you, sir. Thank you for your welcome and inaugural address. Now it's time to start the presentations. The introductory presentation will be given by Mr. Chittaranjan Rege, Head Base Metals at MCX, who will take us through his views on the evaluation of India's base metals market. Over to you, Mr. Rege.
Hi. Thanks, Devo. It's really pleasure to be in the august company of Professor Verma, Joyce, Reddy Saab, and everyone else. Welcome to this webinar. As to set the ball rolling, my agenda is to run you through as to what we have witnessed in the metals market, domestic metals market, where we stand and what we plan in terms of presence. So let me just start with it. So essentially, it's if you see the journey of MCX, I would say, the agenda, the ambition, this thing is to establish the Indian metal price benchmark, so that everyone who is participating, everyone who is operating in any part of the value chain finds great relevance in looking at and participating and taking clues of the price clues from the MCX listed products. Now, just to give you a bit of a background as to where we come from. So we have been, ever since MCX started way back in 2003, progressively we have launched contracts. I mean, we have launched host of it, but in terms of specifically to do with metal segment, both a blend of, ferrous and non-ferrous, we have sequentially launched plenty of products to address and cater to the various industry participants. Right from, say, copper, aluminium, lead, zinc. We did experiments in terms of the size of the contract. So we introduced mini contracts also. Thereafter, we also had experiences on the mild steel contract. Thereafter, when the GST got introduced, we introduced the brass contract, which was delivery based. Then options got introduced. So there is host of stuff which we have been doing, particularly as recently as the big change which has happened in 2019. I would say it's a watershed year, because we converted all our existing base metal contracts, so aluminium, zinc, lead, nickel, and copper, all of them to be delivery settled. So it comes with a big boost to the local industry, and that's the idea with which the entire effort was done. And the vision is that for whatever we list, it has to become top three players in the world. In terms of so what's happening in 2019 was we were aiming to go towards the indigenization, and so extending Make in India, we wanted to extend this thing to Trade in India, and finally, from the MCX perspective, we want people to price in India, price basis MCX, price referencing to MCX, and how we do it is, the first step taken was we converted all the contracts to be delivery settled. Now, moment it is delivery settled, it starts reflecting the domestic fundamentals, the demand supply scenario of the Indian subcontinent, where the supplies, and it's a holistic thing. So not only the primary producers and primary product is being referenced, the rest of the value chain participants, as and when, for whatever, whether they're buyers, sellers, or hedgers, can use this thing. Now, by definition, when MCX has a delivery-based contract, it's a transparent pricing mechanism, because essentially it is settled using the old spot, which means there is constantly. So if all our contracts, barring lead, are all say Thane based, placed close to Mumbai. So entire 4 warehouses which are there in Thane. So essentially, delivered at Thane price becomes the reference for everybody to look at, to trade, to basis, and hedge. So it's a completely delivered price, which means once the delivery mechanism starts, it's only the GST which is subsequently given or taken only for the delivered lot. Until that time, it is entirely trading on the screen basis as a reference, all inclusive price delivered Thane. And for lead, we have base center as Chennai. Another, when we say a local contract, the biggest plus is also comes, it's a local currency denomination basis which is trades, which means you don't have to now look for another alternate mechanism to also take care of your currency price risk. It is inbuilt in what we trade and what we have listed. So I mean, if I have to tell you the sequence, probably it was, so it was March 2019 when we converted aluminium. April it was zinc, June was lead and nickel, and copper was converted in July 2019. So, next month we will complete the 1-year cycle of this thing. But so far till May, in excess of 85,000 tons of these metals have got delivered. A bit of data, further in the slide, but it essentially reflects that we actually had to take massive awareness program to educate to all those who are already participating on MCX that we are moving away from a convention which was essentially resulting into a cash settlement to a more broad-based delivery-based settlement where people from the physical trade, physical participants actually can make or take delivery as per wish, as per will, based on the certain predefined parameters and the criteria of the exchange. And that's how we expect, and we have been propagating, advocating strongly to the participant that now it becomes a very good strong risk management platform for the domestic metal MSMEs. The small medium enterprises need not be worried, need not be worried about where to go for hedging, because entire bit in terms of all inclusive price, the currency price, the landed price, and everything is taking care of that. And it would definitely go down in the value chain, for everybody to refer to. Now, all of this has not been happening in isolation. Under the able guidance of SEBI, ever since they took over the reins of this market. So, alignment of the risk management norms, they have been anyways regulating other markets, but a lot of learnings came from there, and they brought evenness across the markets, the memberships across the members, and multiplicity of that was reducing a lot of cumbersome processes. The clearing function, which previously used to be housed under the exchange, was carved out. So now clearing function is independent, exchange and the trading function is independent. There is no overlap, and there is no any liability with which the clearing function works. It's a separately, completely capitalized, separate company altogether. And host of other things, like the things which was also done is the minimum initial margin. This is as recent as Feb, which used to be whatever the number was has got revised to reflect the realities of the market and the risks which these contracts would have. And in the same sequence, I mean, just to give you an idea as to what else got done is that when the lean period in the agriculture commodities is there, then the margins are different and all this. So host of these things have been happening to strengthen the risk management, so that in the sidelines there are a host of other I would say players which are sitting and wanting to come in, find this markets robust, and they can open mind, they can come and participate here without worrying about how the settlements, how the clearing, and how the functioning would happen. So as I told you that the conversion processes for the metal started say last year. This is just to give you a glimpse of what has been happening this calendar year. These numbers are so the contract lot sizes for aluminium, copper, lead, nickel, and zinc is the second column, which shows. So the trading lot and delivery lot for aluminium, lead, and zinc is 5 tons. For copper, it is 2.5 tons, and for nickel, it is 1.5 tons. Now, essentially, it also realigns everything to the deliverable lot, so that when people transact on screen and convert that thing into your position to be a delivery based thing, there is no mismatch. The entire quantity can seamlessly get converted into the lots which are deliverable. Quantities, while this has been pretty, the numbers till Feb were pretty steady. Goods used are coming in, are going out. But I would essentially like to draw your attention as to what has been happening in last 3 months. A time where the entire world has been kind of standstill, and so we have been also witnessing kind of lull and lockdown across country is when I think all those who were having metal and inventory left with no choice, but now they had a choice but to deliver something on which was delivery of last resort. And we experienced quite a bit of deliveries flowing into our warehouses in March and April. And as the lockdown eases and people start going back, this thing, we see both ways, inventory flows happening. But we believe that the original idea with which this was done, that in addition to price discovery, in addition to the risk management, in addition for people to hedge, it had to position itself as a delivery of last resort. And I believe these 3 months have been a great testimony of what we are set out to do. It also is the time when when practically the spot markets were standstill. We were not getting the polled spot prices, but seamlessly the settlements happened based on the screen traded prices without any problem. And we were able to settle all the contracts to the full based on delivery based settlement. A bit of idea as to where our volumes are now. Incidentally, financial year 1920 is the reference I'm taking because most of our conversions happened in that period. So on an average, the for year 1920 average daily volume in metric tons, on aluminium was somewhere close to about 21,000 tons. Copper was in excess of 40, lead was about 45, nickel was in excess of 16, and zinc was somewhere close to 90,000 tons. On those comparatively, currently our numbers are slightly below the expectations, but I'm very confident that as the lockdown eases and people and the industry is back to normalcy, the numbers, the hedgers, and all of this will go back to the numbers better than what we have achieved in FY 1920. Through this side, I also want to re-emphasize that it's the kind of quantum which say MSMEs will be looking for. I'm sure there is enough liquidity on the markets, enough liquidity on the contracts for anybody to seamlessly get in and get out, no matter how bigger the quantities are. And I would encourage people to try this thing. The third and fourth and fifth column basically essentially gives you a good idea of average open interest which the contracts are maintaining as of today. So aluminium in excess of somewhere close to about 4,500, copper about close to about 8,000, lead will be 3,300, nickel in excess of 1,800, and zinc as robust as 10,000. So I'm sure the numbers will only get better as we move into as we move out of lockdowns and slowly the industry goes back to normalcy. But no matter how big quantities one has to execute, there is enough depth in the markets, enough depth in the contracts for it to absorb and give you a required hedge at any point in time. So as I mentioned you, I mean, something which has been happening and which is worth observing right now is that the fresh set of participants which have been recently enabled. So foreign physical trading companies, if they have a business interest in India in terms of imports and exports, so they become eligible foreign entities. They have got entry here. Mutual funds have been allowed. Portfolio management services have been allowed. The bank subsidiaries which were wanting to come in have been allowed, and banks as clearing members have been allowed. So this is the fresh set of participants which have come into these markets in last last 1 year or so, and products as recent as this thing. So options on futures is again a which was allowed about a year back, and very recently options on goods, allowing the options to settle on the underlying spot, and the index trading, which is another key development which has happened in last 3 weeks, which is going to be going live pretty soon. And we are very hopeful because one of the indexes which has been allowed is also for base metals, and I am sure that this is going to be an additional boon to the fresh set of participants which we are envisaging. In short, to sum up, in Indian context, there is a great amount of zeal to what we want to achieve on the self-reliance side. I am very sure that the emphasis and the scope of the manufacturing sector is definitely going to go up, and with that, we expect a sequential rise in the commodity consumption. And in the manufacturing sector and the trading sector, and when any of these entities would look for a deserving price risk management in the local currency, which is giving you all-inclusive price hedge, so that people don't have to look outside, and the solution is right here. So clearly, with the ambition to be a price setter, we are looking forward for the next year, when all the new products will be launched, and fresh set of participants who have started coming in would start participating in a big way. Devo, that's just to set the tone as to where we are on MCX and what we are expecting on the metals contract.
Thank you, Mr. Dege. Ladies and gentlemen, we are very privileged to have with us Professor Jayant R. Verma, who is the keynote speaker for today. He will share his perspectives on assessing and managing risks in year 2020 and beyond. Just a little bit about him. Professor Verma is a professor in the finance and accounting area at the Indian Institute of Management, Ahmedabad. In his illustrious career, Professor Verma has been a full-time member SEBI, chairman of the Secondary Markets Advisory Committee, and several other committees of SEBI. He has been a member of several renowned committees, such as the Raghuram Rajan Committee on Financial Sector Reforms, as well as the Financial Sector Legislative Reforms Commission, or the FSLRC, besides several others. Sir, we are very delighted to have you in the webinar. Over to you, sir.
Okay. Am I audible now?
Yes, sir.
Yes, sir, you're audible.
Okay. Fine, thank you. Yeah, I'm very happy to be here in this webinar talking about commodity markets. I will take a slightly broader view rather than just talk about base metals. I will talk about commodity markets in general. What are the risk management issues that arise? And wherever possible, I will try to relate that to what's happening in base metals. Okay, so let me turn to the slides. Okay. Okay. So okay, so yeah, when we talk about risks in the commodity markets, the interesting thing that happens is that we get an interaction of two kinds of risks. There are financial risks which are there in securities markets, bond markets, and so on. A lot of those financial risks are present in commodities as well. In addition, there are a bunch of risks which are specific to commodities, what I will call the physical commodity-related risks. Now, a lot of this interaction of these two kinds of risks really began in the 21st century. Because if we went back 25 years ago, commodity markets were predominantly physical markets. So if you were trading copper 25 years ago, You talked about, okay, who is buying copper? What is the demand for copper? Which homes are being wired? How many new homes are being built? How many electric transformers are being sold, and so on? Talked about supply and demand of copper. In the last 10 to 15 years, what has happened is that view of just the end use of copper and how much copper is being mined is no longer enough to understand what's happening in the commodity markets, because commodities got highly financialized. Commodities became vehicles for investment flows. So people started buying copper and aluminium not because they needed it for production or whatever. They bought it thought the price is going to go up. So people bought aluminium because they thought aluminium will go up in price. They bought copper when they thought that it would go up in price. People who probably don't even know that copper is red and aluminium is white. All that they know is that there is a ticker on the screen and you have a price and you see the price has gone up and you forecast that the price is going to go up, and so you go and buy this. This is the process which has been very well studied under the rubric of financialization. So that's one set of risks that have come in via the linkages into the financial markets. At the same time, it remains true that commodities are physical in nature. However much you may financialize it, however much you may say that it is just another ticker on the screen, the fact remains that commodities are intensely physical in nature. You cannot actually move commodities, you can't store commodities simply by clicking on a mouse, the way you could do that with stocks and bonds. When you want to buy shares, you click on the mouse and it hits your demat account, and that's the end of the story. It's all electronic. Commodities are not electronic. There is physical stuff there, physical stuff that is to be stored, physical stuff that is to be moved. And that means that when we are talking about risk management in this area, we have to understand. And what I often observe is that you get a bunch of players in the commodity markets who are fundamental-based investors. So a fundamental-based investor in copper, like I described the 20th century investor, would say, okay, what is the, the cost of producing 1 ton of copper in the mines? What is the demand for copper? What is the rate at which demand is going up? What is the rate at which supply is going up? What is the marginal cost of mining another ton of copper, and so on? And these sets of players tends to ignore the fact that there are a whole lot of financial factors also that are distorting or driving commodity prices, you like. On the other hand, there are the people who have come in. They're tourists from the stock market, if you want to think of them that way. They don't want to think about copper or aluminium or zinc as physical metals. They want to just think about them as investments. Now, these financial people, they tend to ignore the physical frictions. They tend to think that, okay, this is a ticker on the screen and I click and I have bought it. And forget for the moment that unlike buying Reliance shares or Infosys shares, when you buy copper, you have to worry about delivery, you have to worry about storage and stuff of this kind. So what has happened in the last 10 to 15 years is that to manage risks in commodities today, you need to understand both of these risks. You need to understand how they interplay. What are the points in time where the dominates? What are the points in time where the physical side dominates, and so on. So that's what I would talk about. So let me begin with the financial side of things. As I mentioned, this is really beginning from around 2003, 2004. It began in the alternative investments world, where people realized that commodities have a bunch of very interesting characteristics when you view them as investments. At least back then in the early 2000s, commodities tended to be uncorrelated with other assets. No longer true today. They've got highly correlated as well. Then the thing which attracted people to commodities was that commodities are a good inflation hedge. So at points of time where you get worried about inflation, about, and in the last 5-10 years, people have got worried about central banks printing money as if there is no tomorrow. And people get worried, if central banks print money like this, at some point inflation is going to happen. Well, last 10 years, there has been no inflation despite all the quantitative easing that central banks did. But you have a bunch of people who worry that someday if you print money like this, it will produce inflation. And if you worry about that, then what do you want to buy? You want to buy real assets. And commodities are real assets. Nobody prints copper and aluminum. So there are a bunch of people who say that, look, commodities are unprintable assets. Central bank can't just print more of them. It cannot produce a huge supply of this simply by running the printing press. And therefore, these could be valuable assets at times when people are worried about inflation. And what drove a lot of people into commodities was that the period from around 2003 to around 2008, there was a 5-year period in which commodity prices rose massively across the board. I will have a couple of plots on that. And that attracted a whole lot of people into commodities. And so by late 2000s, commodities had become intensely financialized, billions and billions of dollars of investments flowing into that. And then in the last decade or so, we have seen the further process of democratization of commodity investments. So long as it was hedge funds which were doing all of this, it was commodities were accessible to those who had millions of dollars of investments and therefore could buy into a hedge fund. But we have got a variety of instruments which have made commodities available retail. And as you will see, this whole slide is about what's happened globally. I will come to what happened in India in the next slide. But predominantly, it was a rise of commodity ETFs, exchange-traded funds that invested in commodities. And what happened was that for a retail investor, buying commodities became nothing more and nothing less than buying mutual funds. Instead of buying mutual funds that bought stocks, you bought mutual funds that bought commodities. And it became accessible to the entire retail universe. That's the process of democratization that happened. And of course, this is gotten into a whole lot of more sophisticated, what some people would call toxic products, the inverse levered ETFs and so on. So in the last 5 to 10 years, in the early 2000s, you had to be a multi-millionaire and go to a hedge fund to do it. Now, any Tom, Dick, and Harry could do it sitting at home. And this is what has driven an enormous amount of financialization of commodities. Now, what does that do? And what did that do in India? Well, we also got highly financialized. The commodity derivatives market in India also is highly financialized for 2 reasons. A large part of our commodity derivative markets, this is more true about the energy and precious metals, less true about base metals, which has got indigenized. But when you talk about precious metals, energy, a large part of that is cash settled against global markets. And therefore, if the global market is financialized, then the Indian contract which cash settles to that is financialized, whether you like it or not. The second factor is that the Indian commodity derivative market itself has borrowed hugely from the stock market. So much so that, and this is true at all levels. If you look at the investors in commodity markets today, a lot of them are, again, people who just migrated from the stock market. That's true about brokers. A lot of the commodity derivative brokers are people who came in from the securities markets. And the reason for that was that in the early to mid 2000s, The only people with experience trading derivatives were the equity markets, because that's where the derivatives market, the derivatives became very liquid first. That was where the expertise for derivatives were. And those were the people who immediately entered the commodity derivatives market when that opened up. And this has been true about the regulators as well. The regulatory framework for commodity derivatives is borrowed wholesale from the securities markets. This was true even before the regulations were handed over to SEBI. Even when it was run by FMC, we looked at it, it was borrowed wholesale from the securities market. So it's not something that happened only internationally. It happened in India as well. Enormous amount of financialization. Now, what does financialization do? What it does is that it distorts prices, or it drives prices. Drives is a more neutral word. Distorts is, if you think that prices are going wrong because of all this money sloshing around. Now, this driving happens through a variety of channels. The key thing is that commodity prices are now driven by financial flows. It is the financial investor who is often the marginal investor in many commodities. Now, it is not that they're also investing in commodities. In many situations, they are the marginal investor. They are the price-setting investor in many commodities. Now, when that happens, you get linked to a variety of things in the financial markets. Financial markets, we know, go through risk-on, risk-off cycles. Now, if you get into a risk-off cycle, like, for example, what happened in March of this year, there is this huge new risk that's come in. And the financial investor says, let's dump all risky assets and let's go rush into safe assets. In the old days, they would have only sold stocks because that's the risk asset that they held. Now, among the assets that they sell will be commodity ETFs. They will be commodity derivatives because that's the other set of things that they invested into. So in a risk-off period, all commodities get sold, and in a risk-on period, everybody piles on to commodities. And you also get, I mentioned earlier that the initial attraction of commodities was that it was uncorrelated, but enormous amount of financialization makes it correlated. It is today, received wisdom in the commodity markets that commodities are highly correlated with the US dollar. When the dollar weakens, commodity prices go up, commodity prices go up, and when the dollar strengthens, dollar commodity prices tend to fall. Very interestingly, this is a phenomenon which is purely a 21st century phenomenon. Pre-financialization, there was no such thing. Similarly, the correlation with the stock market, especially Shanghai. Again, the joke is that if Shanghai goes up, every base metal is up. Now, this again is really only a post-financialization phenomenon. The last thing, which is even less understood, because those who are trading all these assets immediately see, if you're trading stocks, currencies, and commodities, you quickly see they're all getting correlated. But there is another very important dimension, which is that credit conditions influence commodities a lot, because there is an enormous amount of commodity collateralized borrowing. What a derivative market does is that lending against commodities becomes very, very safe, because you can take 1,000 tons of copper and put copper futures on top of that to get rid of the price risk. And borrowing against that is a very, very safe borrowing. So now what happens is that credit conditions, how easy is it to borrow? The funding environment, that starts driving commodity prices, because when liquidity tightens, a lot of this commodity collateralized borrowing gets unwound, and then all that inventory gets dumped onto the markets, pushing prices down. And in other periods when credit is very, very abundant, then there's a huge amount of inventory that gets built up financed with this. And the second part of this is that unrelated commodities become highly correlated. If you look at the 20th century model, you would say that, look, if I'm trying to understand wheat, I would look at, okay, what is the weather like? Where is there a drought? Where is there a frost? what is the wheat output like, what is the wheat demand like. And then if I'm looking at copper, I would look at, as I said, what is the construction, new homes being built and new transformers and stuff of that kind. And you would expect these to be highly uncorrelated. These are very different supply demand positions. But if financial flows start driving it, then they all get correlated. So what you get this phenomenon that, like sometimes happens in the stock market, where you say that if I could not buy TCS, then it's okay to buy Infosys, and if I couldn't buy that, it's fine to buy Wipro. They're all more or less the same. Now, the same kind of thing starts happening in commodities, that if copper has already gone up, maybe I can buy aluminum. It's all the same. And that makes all commodities highly correlated. And let me just show you a plot of what has happened in the last 2 decades, which would show the extent to which this driver has been important. Now, these plots are 3 totally different commodities. But if I didn't tell you that, at first glance, you would think that I took the same curve and made 3 copies of it. But they're actually 3 totally different commodities. The green line on top is copper, which is a base metal. The orange line in the middle is soya oil, which is an agricultural commodity. And the line at the bottom is Brent crude, which is an energy product. 3 totally different commodities from totally different sectors. But you look at the price plot, they all look the same. You all see the same phenomenon, that from around 2003 to 2008, everything went up. You had a huge mega upswing in commodities, super cycle it's been called, the huge super cycle in commodities, driven a large part by financialization. Then you had the global financial crisis of 2008. All of them came crashing down, then all of them recovered. And then you can see 2016, the commodity crash again, everything goes down and then recovers and so on. So you get this thing that, if you're asked from a fundamental point of view, what is common to soya oil and copper, you would be hard pressed to find anything in common. But once you put financial flows into that, then you say, yes, they're all the same kind of, they're the same kind of phenomenon that's driving that. These are 4 different base metals, and you can see the same thing. They all look the same on a 20-year horizon. Everything driven by the same thing. Everything goes down together, goes up together. So when you are worried about risks in commodity markets today, you have to look at what's happening in the broader financial sector and take that into account. Okay, so that's one side of risks. The second side, as I mentioned, are the physical risks. And this is the stuff which the financial guys tend to lose sight of. Those who think that aluminum is just another ticker on the screen, they forget that these are intensely physical things. So what are the physical frictions and risks involved? I see 3 big frictions in physical commodities. First is storage costs and bottlenecks. Second is transportation costs and bottlenecks. And third is what the commodity people call a convenience yield, that commodities are not pure investments. Commodities are used in consumption or production. And that, the investor forgets that this happens, but that's hugely important. The result is that basis risk of, let's say the price of crude oil at 2 different locations in the world can differ hugely. Why? Because there are transportation bottlenecks and storage bottlenecks. Calendar spreads. The price of Brent crude today versus Brent crude 1 month later can be hugely different because of storage problems and so on. Now, these are phenomena which do not exist in financial assets. Financial assets have near zero storage cost. You pay a flat fee for your demat account, and after that, it doesn't matter whether you have 1,000 shares of Reliance in it or 10,000 shares in it. Transportation, there's no transportation cost. Financial assets move around the world at the click of a mouse. And well, you don't eat and wear stocks and bonds, so it has no end use distorting things. And the financial investor needs to remind themselves that there are these three frictions. Otherwise, there will be risks that hit you which you never anticipated. Storage. Now, it depends on the commodity, actually. It's a big problem in oil and natural gas. And all of us who saw crude oil settle at a negative price in April know that storage is a huge problem. Oil and natural gas, the problem is that they're both bulky and hazardous. In most countries, you need an explosive license to store it. So it's not something that you can just store in your backyard. Precious metals, the problem is that you need secure. You can't really store $1 million of gold in your home. You would want it in a bank vault. Base metals are less affected because you can literally store it in the open. I'll show you a photograph of copper being stored in the open. And storage is also affected by availability of credit. I mentioned this earlier, but let me remind you of that as well. This is a photograph from 8 years ago in Shanghai. That's copper just piled up outside. Now, you can't store crude oil like this. You can't even store gold like this. That copper is probably worth $5 to $10 million. Now, you can't just have $5 to $10 million of gold just lying outside in the open. Yeah, but base metals, you can do this. And of course, even this, you did this because the normal warehouse got full. So yes, base metals, the problem is a little less because you can actually do stuff like this. But in most other commodities, you can run out of warehouses. And that's something, as you saw in April crude, that can be a very big problem which you need to worry about. When you are risk managing a commodity position, you got to keep track of storage and what amount of storage is free. Transportation costs and bottlenecks. Yes, crude again is the best example. The amount of difference between Brent crude and WTI crude is again telling you about both transportation and storage. But even something like gold. Gold is you can just put it onto a jumbo jet and you can carry very huge amounts of gold. But in March of 2020, you had something like 5% difference between London and New York prices of gold. Why? Because when all flights are shut down, how do you actually send gold from London to New York? Second, again, this is the intensely physical nature of this. London trades gold in 400-ounce bars and New York trades them in 100-ounce bars. If you want to deliver in New York, you have to melt it down to 100-ounce bars and do that. And if the Swiss refineries are shut down because of COVID, you can't do this. Now, this is again the fact that it's intensely physical. Even something like gold. Gold is, central banks allowed to say that gold is just a currency. But no, it's not a currency. It is a commodity which has to be melted, which has to be stored, which has to be shipped. And you get all of this. Bid-ask spread in March 2020 in gold in London. The center of the gold market was 7%. Difference between buying and selling prices, 7%. Why? Because of all of this. And if you're risk managing a commodity position, you've got to worry about these issues that can crop up. The final friction in commodities is that, look, commodities are useful things. Unlike stocks and bonds, which are useful only as an investment. This is physical stuff which is used for consumption or to run a production process. So let's imagine that you are sitting in April, lockdown is in place and you can't buy anything. Well, if you are holding a lot of wheat futures, you will still starve, right? If you want to cook something in your kitchen, you need physical wheat. So this is the stuff that when you're talking about commodities which are intrinsically useful, the paper, the ETF, the future cannot substitute for the physical stuff. And therefore, you will get huge disconnects between physical commodities and paper commodities and can cause huge amount of backwardation. just the storage bottlenecks can cause super contangos. Huge demand for the physical stuff can cause huge backwardations. And that again is a risk that you need to worry about. Imagine that you had a calendar spread in one of these and backwardation blows out or super contango blows out. These are risks that you need to worry about. So what does all this mean for managing risks in 2020 and beyond? A couple of things. What are the banana skins on which you can slip on risk going forward? I think COVID-19 has reminded us that there are structural changes that are happening. Climate change is another one on the horizon. These are capable of causing very large structural changes in the supply and demand for commodities. Climate change in particular is threatening to cause a large amount of stranded assets. If you look at the big oil companies in the world, the amount of write-down they have taken, they are just writing down whole oil fields left, right, and center, saying that these oil fields will probably never be economically viable. So that's something that climate change is doing. COVID probably accelerated that process. But COVID is also causing huge structural changes in the supply and demand for particular kinds of commodities. The second thing is that spread trades. Now, the financial guys tend to think of spread trades as as arbitrage. They say, look, spreads have to mean reward. Spreads are zero risk. Maybe in financial assets, that's true. Even there are problems. But in commodity assets, spread trades are not arbitrage. They are not risk-free. The mantra here is that every spread prices a constraint. It might be a storage constraint. It might be a transportation constraint. It might be some other constraint. And constraints can change massively. Constraints are cropping up today. Constraints can become more intense, and spreads will just blow out when that happens. And you have to worry about that if you're managing any of these risks. And the last thing that the financial guys need to remember is that when it comes to physical commodities, the physical players have a huge advantage. They control storage, transportation, processing facilities. And you can never compete with them with their in-depth knowledge of what these constraints are like. Okay, so I will stop here, and I'll be happy to take questions at the end.
Thank you, sir. Thank you for a very insightful presentation on the various aspects of risks in the commodity markets. We'll definitely have questions at the end. The special address today will be by Ms. Joyce Zhang, who has joined us from Singapore. She will share her insights about the state of global aluminium and alumina and battery metals market, and the role of Asian market fundamentals in those commodities. So over to you, Joyce.
Thank you, and I would like to give kudos to MCX, Mr. Reddy, and Prof. Varma. I definitely had a lot of takeaways myself from previous to very insightful presentations. So today we are going to look at a quick market update and a slight overview on global aluminium and alumina, as well as the battery metals market. A quick introduction to SMP Global Platts. We are the leading independent provider of information and benchmark prices of the commodities. We cover all sorts of commodities, including oil, gas, agriculture, metals, etc. And we are a division under SMP Global. We are in parallel with SMP Global Market Intelligence, SMP Global Ratings, as well as SMP Dow Jones Stock Index. Moving on to aluminium and alumina. We have noticed that global aluminium prices were hit very hard. Apologies, should be the previous slide. Yeah, my apologies on that. All right, so on this slide, while global aluminium prices hit very hard by coronavirus this year, and we notice on this chart that both LME, which is the red line, and SHFE aluminium prices, which is the green line, dropped to 4 years lows in the first quarter of this year. We can see further from this chart that the LME price dropped even further, starting from March onwards, while the rest of the world closes during the pandemic spread out from China to other countries, while the SHFE price has a little recovery since March, and it's on a more uptrend as China reopens. Moving on to the next slide. What are the impacts on Asia alumina price, as alumina is key feedstock for aluminium? Well, we have noticed that on this price chart, the red line represents the alumina price in the seaborne market, which is the FOB Australia price assessment that we publish on a daily basis. As well as the green line represents China Ex-Works Shanxi alumina price. We also publish in the same time. So we noticed that domestic Chinese alumina prices rose initially in the early stage of COVID-19 due to the higher cost in Chinese domestic logistics because of the nationwide lockdown. Well, then we noticed that imports increased as Chinese smelters turned to other forms of transportations, including rails, etc., directly from ports. So that's providing support to the international prices, to this seaborne price. And we noticed that green line that China prices fell from March as the transportation issue eased, but China prices rebounded at the end of April. We noticed that seaborne FOB Australia price for alumina also rebounded in May, and that's mainly because of a strong Chinese demand for alumina. Moving on to this slide, with aluminium prices at 4 years lows, and there have been news, etc., starting from March that about 30 to 40% of smelters globally are estimated to be making losses and thus cutting some productions. However, we noticed that since March, April, and May, in the 3 months, that production cuts have provided very minimal support to the falling aluminium and alumina prices. Well, from World Aluminium Organization and Platts surveys to the market, we noticed that for aluminium, there are at least 1.4 million metric tons per annum production were affected by COVID-19. And China itself was among 60% of the total smelters production impacted. We also noticed that in the first 4 months of this year, global aluminium production were about 21.3 million metric tons, which compared to last year's total output of 63.7 million metric tons, we can, if we are taking the average of the first 4 months production, we actually could possibly expect a slight surplus in the global aluminium market. On the other hand, on alumina, we noticed that there are 425,000 metric tons per annum at least being affected, while taking 2 parts of alumina to produce 1 part of aluminium. And we noticed that the impacted output could be little as compared to the metals itself. However, if you look at the first 4-month figures of outputs in 2020, using the same formula, if we divide the 43.6 million by 4 and times 12, we notice that there might be a very slight tightness in the total global output for alumina. Moving on to the next slide. There are also some other factors impacting aluminium and alumina prices. First of all, global economies are looking quite dismal, if we are going to put that in that word. China GDP itself fell 6.8% in Q1, while the United States and the United Kingdom were also falling. As Prof. Farmer has mentioned before as well, oil prices went into negative for the first time in history in April. That's the WTI contract. Well, even though the physical oil prices were, the Brent were still quite positive as compared to WTI, and oil prices have rebounded slightly since April to now around, for Brent is now around $40 and above per barrel. However, this huge price plunge in oil is also damping market sentiments, but that also helps to reduce costs for a lot of manufacturing industries. And also falling demand in construction and especially automobile, which the sector has been performing quite weak since last year, we have noticed, and as well as consumer electronics sectors caused the slowdown caused by COVID-19 and the recessions, etc., are also quite of concern. And interestingly, we noticed that China had been importing primary aluminium due to an opening arbitrage window between LME and SHFE prices in during March to April, which is a very rare case, as China takes about over 50% of global aluminium smelting capacity, and China usually exports its aluminium and downstream products to other countries. Well, China also had increased its alumina imports in March and April on speculations during the strong SHFE price recovery as China recovers from COVID-19. Moving on to this slide, on this chart on the left, it shows the spot and as well as quarterly premiums trend for Platts' strongest aluminium benchmark in APAC region, which is the CIF Japan Aluminium Premium Assessment, MJP in short. So we notice on this chart on the left, the spot premiums have been falling since mid of 2019 last year. And that downtrend kind of like slowed down end of this December, as the LME prices also softened during the same time. Well, spot Japanese demand were pretty much at standstill in this year, in the first half of this year, due to mainly due to COVID-19. And also we have noticed that the quarterly premiums have been coming off from its highs and to recent low levels. Well, if we are comparing to a global aluminium premiums, so at Platts, our international benchmark prices in aluminium also include the US Midwest premium, which on the right-hand side of the chart is showed in green color, and the Platts European aluminium premiums, the in-warehouse Rotterdam assessment is showed in the color of blue. So when we compare this, the Asia picture with a global picture, we can see that starting from this year, 2020 January, we noticed that the the softening of Asia regional premium was still range bounding, more like range bounding as compared to US and Europe. And we noticed the sharp decline of Europeans in warehouse Rotterdam premium in late March, early April. And that's mainly due to the lackluster demand hit by COVID-19 in Europe that time. Meanwhile, US Midwest premiums are also softening ever since the starting of this year, while we see slight recoveries in US Midwest premium recently as US is getting back to normal from COVID-19, etc. Moving on to the next slide, we would like to highlight that spot liquidities for alumina actually surged quite a lot in April. So in April 2020, we observed a total physical volume of 540,000 metric tons of alumina being traded, which was up 77% from March. And it's also a record high for trades seen in a single month in recent 2 years. And also interestingly, on this chart, we can see that most of the volumes are highlighted in red from Australia, where there are is the major origins of alumina being produced outside of China. And the dark blue, the navy colored block actually represents the alumina coming out from India. We noticed that there have been active tradings. There have been active importing of Indian alumina by Chinese in 2019. However, in recent months, that volume kind of like softened as the Australia volumes kind of like increased. Moving on to the next slide. Well, we also take the CIF Japan Aluminium Premium, the MJP Premium, and publish import parity prices for both aluminium and alumina for the market to compare the price differences in and outside of China. So on the right-hand side of this chart, we notice that China, when we take a China all-in import parity price versus a China SHFE aluminium price, we notice that the green line represents the China SHFE, the Shanghai Futures Exchange price, surpassed a China all-in price somewhere around April. So that's where we see China started to import the primary aluminium. On the right-hand side chart, the FOB Australia versus China import parity price for alumina, we noticed that there are also some interests for Chinese imports for alumina in this year. If we look at the right-hand side of this chart, where the prices where we see the sharp decline during COVID-19, and we noticed that if by comparing FOB Australia, by comparing the China price, which is represents by the green line, in USD dollars with the FOB Australia price, we noticed that Chinese alumina prices have been relatively higher than Australian, the overseas seaborne import prices. So that kind of like explained the behaviors of Chinese market participants during COVID-19. All right, so well, with that, Asia 2020's outlook as for now do leave us with very big question marks. First of all, COVID-19 is still out there, as we might have noticed that people do worry about a second wave of COVID-19, even though a lot of countries have eased their lockdown measures. And secondly, US-China trade war, geopolitics factors are impacting quite a lot on the aluminium metals prices. And thirdly, global economies were also looking quite uncertain as of now, as China itself, it didn't set its GDP targets during its recent 2 sessions this year. So that leaves a lot of question marks behind that. On market fundamental side, there are expected a global aluminium supply surplus between somewhere around 1.5 million to 5.5 million metric tons this year. And on the aluminium production side, China is still expanding its aluminium capacities for metals. That's about 3 to 4 million metric tons this year. And for alumina, China is trying to expand about 3 million metric tons, which convert to the metals will be 1.5 million metric tons in terms of metals. And not only China, in the Middle East, there are also new capacities coming up online. Alba is ramping up its new line, and the actual output were expected to rise 200,000 metric tons this year. However, on the demand side, while global automotive industry, the downtrend and cutbacks are quite uncertain at this moment as well. And as we mentioned before, the global economies are looking quite dismal, especially Japan. Japan has announced official recession. With all of that on the macro side and supply and demand side, it seems to the market that there are a lot of question marks and a lot of neutral or even more to the negative sentiment. However, there might be something to look forward to. Well, electric vehicle sector is definitely one of the interesting areas that people are looking forward to. 5G and also high-end smartphones and consumer electronics, etc. In this year, post COVID-19, there might be a recovery of people's buying. So the buying parties might possibly could be expected, as China has seen from the stats and figures that the consuming power has been back online. So we might be able to expect rest of the world to pick up soon, later this year. So moving forward to electric vehicles, EVs, and battery metals. On this chart by Platts analytics team in New York, this is a longer term forecast for global EV fleet. As we can see from this chart, the total numbers of EVs are expected to grow exponentially in 20 years. So on this timeline of this chart, we are now at the very left-hand side of this chart, and we can see that the growth is expected to be huge in 2040 on the right-hand side of this chart. China and Western Europe itself is expected to account for over 50% of the total global EV fleet, and China now itself takes about 50% of global's total EV output and sales. China produced about 1.2 million units of EVs last year, and the government is trying very hard to back up that. Well, on this slide, we are quite interested to look at the two key battery metals ingredients for lithium-ion batteries used for the electric vehicles, and as well as consumer electronics like our mobile phones, scooters, as well as like drones, etc. So why are we looking at lithium and cobalt? because lithium and cobalt are the most expensive metal elements in batteries, and battery takes about 50% of a whole EV cost. So looking at this chart, on the left-hand side of the chart, this data is from SMP Global Platts sister company, Market Intelligence, and last updated as of end of May. So on the left-hand side of these charts, we notice that lithium demand is expected to increase about 96% by 2024. And most of that do come from batteries, and 50% of that demand would be coming from electric vehicles. On the right-hand side of this chart, cobalt demand are also expected to increase by about 55% by 2024. Well, cobalt, we can see from the blue blocks that the increase of cobalt demand from electric vehicles were actually faster than its usage in any other chemicals. With the demand pictures looking quite brilliant, quite good, however, spot prices for lithium and cobalt have been falling since 2018, and that's mainly on current sufficient supply in China, as China takes about the majority of the demand for the lithium and cobalt chemicals used in the batteries. So looking at this chart, price chart in red on the left-hand side, this is the Platts assessed lithium carbonate Chinese price in Chinese yuan per metric ton. And we noticed that there's a clear one-way trend, that even though there might be slight jitters during the time frame, however, that price overall trend of the price is coming down due to ample supply and also slower than expected demand, delayed, or we can put in that way, delayed demand. As we noticed, the red arrows showed that the price trends during recent months in COVID-19, and in COVID-19, the demand indeed slowed down, as China's auto industry was hit super hard by COVID, and in February, its new energy vehicles output almost turned to zero. On the right-hand side of this chart, the green line represents cobalt sulfate Chinese delivered price. And differently from lithium carbonate, we do notice there are up and downs for cobalt sulfate, and that's mainly because the cobalt sulfate feedstock are mainly coming from South Africa, especially DRC. DRC constitutes roughly around 70% of global cobalt mining and supply. So the uncertainties from DRC kind of like provide some support to the falling prices during the COVID-19, as overall demand is slowing down. So that we see the green arrow, the small green arrow on the right-hand side, on the very right of the chart, that is providing certain support to prevent cobalt sulfate prices from falling further. With that, moving on to the final challenges and opportunities conducted by us market surveys in the batteries and electric vehicles industry, there are quite a few things to look forward to despite the price decline. So the first thing would be the market is expecting vertical resources integrations in terms of downstream investments in upstream minerals and also upstream investment in downstream. So like, for example, Tesla has signed a supply contract with Glencore to purchase its cobalt, and there are a lot of other automakers, global OEMs such as BMW, Mercedes, etc., are trying to look for investment opportunities in upstream minerals in lithium, cobalt, nickel, and others as well. And secondly, market is expecting further horizontal industry consolidations, and that's more obvious. The trend is more obvious in China, as when the prices surged due to EV hypes 3 to 4 years ago, there are a lot of new emerging producers of the battery metals chemicals in the market, competing with the major ones, dominant ones. However, since we have already noticed that the prices of lithium and cobalt has come off from its peaks since 2018, there might be M&As and reinforcements across the industry chain. And thirdly, which market do expect growing market liquidities in more transparent pricing, as well as hedging tools for battery metals. As Prof. Mama has mentioned, that managing risk is crucial to commodity trading, etc. So far, because battery metals area is an emerging and quite new market, there hasn't been any available exchange traded contracts for especially for lithium, and which could be some opportunities moving forward with the growing liquidities. And fourthly, the technology shifts and developments are also quite important to the battery metals and EV sector, as as we have touched on before, that global governments are supporting the electrification, and by giving a lot of subsidies in that. And China itself is cutting its subsidies and require more better quality of the batteries and vehicles to be qualified to claim the subsidies. And also the changes in technologies could also change the different types of batteries used in that. There might be slight market shifts in demand for example, like cobalt, and that's quite interesting to monitor on. And also the fifth point, market is expecting continuous drive towards an energy transition as global pollutions are escalating, and global and a lot of governments across the globe are trying to prevent or trying to do something to help with the global warming, pollution, etc. And that's the drive behind the energy transition, and that does require a lot of government support to that. And lastly, mass adoptions of EVs. So this market is expecting consumers, individual consumers like every one of us, could possibly accept EVs when we consider purchasing a car, if that's possible. And yeah, with that, I would like to conclude the presentation for today. And thank you again. Thank you so much. Please do feel free to reach out to us via the email addresses regarding aluminium, alumina, and battery metals. And that's all. Thank you so much.
Thank you, Joyce, for this wonderful exposition into and insights into the aluminium and the metals, battery metals market. Before we move into the question and answer session, for the benefit of the audience, I would briefly want to introduce you. I should have done it earlier, actually. Ladies and gentlemen, Ms. Joyce Zhang is Associate Editor at SMP Global Platts non-ferrous metals team, covering Japan aluminium and battery metals market. She graduated with a dual master's degree in quantitative finance from the Cass Business School and Singapore Management University. She is also a scholar with a bachelor's degree in engineering from the Nanyang Technological University, Singapore. So with that, we have completed our 3 presentations, and we would take questions now. I would request all our speakers to join us and take some questions. The first question, I think, Professor Verma, is for you. The question is, are regulators overseas themselves posing a risk to the markets? Banks and other intermediaries are being forced to exit commodities due to capital adequacy rules, causing liquidity to reduce and making prices more volatile. So the question is, do you think the regulators themselves are posing a risk?
Yeah, I really don't think that is so much to blame here. There's probably more merit in that argument when it comes to illiquidity in the bond market and so on. But the commodity markets, I don't think have been much affected by the withdrawal of banks from there, because most of the banks' trading units got spun out into hedge funds and proprietary trading desks and so on. So I don't think that has been a very big factor. That's my view here. Not too much of risk-taking capacity was removed from the market by doing that.
All right, sir. Another question for Joyce. With a significant amount of minor metals being sourced from China, what kind of impact it can have in the EV markets, the electronic vehicles markets?
Yes, in EV markets, well, the current price picture, we surveyed a lot of markets are still to expect further prices down, and as well as the EV total figures of EVs produced in China would possibly see a slight decline as well this year due to the impacts from COVID-19, as COVID-19 has slowed down everything. On the metal side, well, lithium and cobalt, the fundamentals and the supply and demand sector market is still expecting a supply surplus of lithium carbonate, and as well as the lithium hydroxide, which is also another type of chemicals that use into the lithium ion batteries. And on cobalt side, even though that supply constraints for its raw materials from DRC remains uncertain, however, cobalt sulfate supply, the chemicals itself, is quite sufficient in Chinese domestic market, and that's altogether with a slowdown in demand. That's kind of like all waiting on the prices, pressuring, putting some pressures on it.
All right. I think there's another question for Joyce. What do you think was the reason behind the surge in aluminium volumes traded in April? I mean, in the middle of COVID, there was a surge in aluminium volumes. What could have been the reason? A question for Joyce.
Yeah, thank you for this question. I would like to clarify that the surging volumes were traded for alumina in April, as April China has recovered faster than the rest of the world. So China has started its activities in April onwards, and meanwhile we can see that from the previous arbitrage price chart that there has been arbitrage window for Chinese imports and alumina as well, starting somewhere around April. So that all putting that together, the strong demand from Chinese and as well as the arbitrage, that all lead to increase in spot traded volumes in April.
All right. The next question is for Professor Verma. I think this comes from the slide that you had on where you said that the physical market players actually have a lot of control in price setting. So the question is, don't you think financial market players have an equally, if not bigger, advantage of big money compared to the, I mean, they have the deeper pockets and bigger money to chase the commodities. So don't you think the financial players have a bigger say in setting prices compared to the physical market players? Professor Verma, please.
Yeah. No, see that the point is not about say in setting prices. Yes, the financial money moves prices. That is not the issue that I'm raising. The issue that's raised is that from a risk management point of view, the physical player has lot more options. The physical player can take delivery. The financial player often cannot take delivery. So again, if you look at April, who benefited from negative prices? The only people who benefited were the refiners who could actually take delivery. If you were a financial guy, there was very little that you could do with that. So you need to have the storage facilities, you need to own the pipeline. I mean, even if you owned a refinery, it was not enough. You needed the pipeline that would allow you to take the crude from Cushing and take it all the way to your refinery. So unless you own the physical infrastructure, there are certain things that you cannot do. And yes, so the financial guy is fine so long as you stay away from the delivery month, or you roll over the contract 2 weeks before delivery, you're fine. But if you want to play this game close to delivery, then you need either to have all this, or you have to track all of this. You got to track what's happening to storage, what's happening to pipeline capacity and stuff like that. And the physical guys will know that much better than you will as a financial player. So it's more from a risk management point of view that I was making that statement. Yes, the market can be moved by financial players as well. In fact, I would go further. The market is sometimes moved by dumb money. Yeah, but from a risk management point of view, that's not what one is talking about. The question that we are asking is, how can we manage the risks better? And then the financial people needs to be aware of that disadvantage. I'm not saying that you don't trade, but you must be aware that you are trading with one hand tied behind your back. And if you still think that you have the money, the superior understanding, leverage, whatever, go ahead and do it. But please don't forget that you have one hand tied behind your back and somebody else is playing with both hands free.
Right. A related question. I think again for Professor Verma, in the fast-moving geopolitical situation, do you think the physical players can take advantage and pose risk to international trade and create artificial mismatch between demand and supply? In such a situation, what should the regulator plan for this post-COVID volatile situation?
Well, there is nothing much that the regulator can do on this other than review position limits, review the margins and so on. That in volatile periods, your margins need to be higher and your surveillance needs to be much stronger to look at
right.
whether people are trying to do any abusive trades and stuff like that. Yes, that's all that the regulator can really do there.
Right. I think there's one question for Joyce about ALBA, Aluminium Bahrain. With Middle East ramping up capacity and particularly in the context of ALBA ramping capacity, do you think this could push prices down further, aluminium prices? This is for you, Joyce. In the context of ALBA, Aluminium Bahrain, ramping up capacities, could aluminium prices be depressed further?
Yes, so thank you very much for this question. This is a very good question. And I think in terms of aluminium prices, we have to break down aluminium prices into two parts. One is the underlying aluminium price, and the other part will be the premiums. So on the well, first of all, maybe we look at premiums, as premiums is the regional reflect more like a regional price. For example, the CIF Japan premium reflect more like Asia ex-China price, as Japan takes imports about 50% of total primary aluminiums in Asia, which is a leading demand center. well, on Japan premiums, with all the increased supply, the more available supply from Middle East, according to market sources, do post some pressures on the regional premiums. Well, however, as this region, as in Asia region, there are more Australian, Canadian, the so-called Western metals, as well as a lot of metals are produced in India and being exported to Korea, Southeast Asia, etc. So metals from Middle East actually do not flow that much as compared to the metals from Middle East flowing into, for example, US and Europe. So that according to market sources we have been spoken with, a lot of traders and Japanese consumers, they actually do not see that much of impact to further pressure down the premiums. However, there are certain weightages on the premium side. As the second point, the global aluminium prices might be facing a lot of pressures from the supply surplus, the total overall global picture. So that could possibly be hanging there. The pressures might be there until we really see a demand recovery or demand pickup.
Right. There is quite an interesting question for Professor again. Sir, do you think that commodity index derivatives trading can impact positively or negatively the price discovery, the process of price discovery of the constituent commodity futures?
Yeah, so what has been observed is that when there is a lot of investment flows into index products, what happens is that the commodities that are part of that index tend to become highly correlated with each other. So it's something like this, that the average correlation between two commodities which are in the index might be, let's say, 0.6, while the average correlation between two commodities which are outside the index may be only 0.3 or 0.4. So there is a much greater correlation that happens when they are part of the index, because there are a lot of money flowing into index products. And when money pours into an index fund, then the fund goes out and buys all these commodities, so all their prices will rise. And when there is redemption, the fund is going to dump all those commodities. So that's one factor which has been observed, that this tends to happen. That's been observed in non-commodities as well. So the rise of large index products makes stocks more correlated with each other. The same thing has been observed with bond market ETFs as well. They tend to get more correlated with each other. So that's one thing which happens. There are two ways of looking at it. One is that they get correlated and they all become the same. If you are an active investor, then it says that, look, maybe there is scope for somebody with more careful fundamental analysis to make money on this, because prices may deviate because of the dumb money which is just buying the whole index and not understanding fundamentals of individual commodities. And if you understand those fundamentals better, and you have the staying power, right? Because you have to outlast the flow of money coming from the fund. If you have the holding power, then you may be able to make money by active management and better understanding of fundamentals. But yes, this is what has been observed, both in commodities and elsewhere. So the correlation between two commodities which are part of the GSCI is far higher than those which are not. That's been very well observed.
Right, sir. I think we have just a little more time for one or two questions. I think there is a question on another aspect, the causation being the same, but the effect being on some other field. The question is, can massive inflow of speculative capital in commodity derivatives abet the price volatility on spot prices in the spot market? So I think a part of it is answered, but yeah, specifically on the spot market, if you could share some light.
Yeah, you see, you know, think about supply and demand. So we think of supply and demand as the amount of, say, the supply of copper is how much new copper is being mined, and the demand for copper is how much is used to wire homes and so on. That's one way to look at supply and demand, but that ignores one other thing, that supply and demand are also influenced by what is happening to inventory. So supply can come by drawing down inventory, or demand can be simply demand that goes into inventory. So that is also a source of supply and demand. And what the financial flow does is to impact the storage. So if there is enormous amount of money, financial flow coming in, that may support huge amounts of stockpiling of the commodity in physical storage. And that stockpiling is actually withdrawing supply. So let's say 1,000 of copper was mined, but out of that 1,000 of copper, 200 just went into inventory. It is as if only 800 of copper was mined. And if only 800 of copper is mined, obviously the price goes up. So it will impact the spot market because it impacts physical storage, because all these flows ultimately through some channel or the other end up impacting storage. So yes, when the first hit will be on the derivative, but ultimately spot will also be impacted, and that gets impacted via either stockpiling of inventories or drawdown of inventory.
All right. We have one question for Mr. Rege. So the question is that what do you think would be the impact of institutions when they start participating in the commodity market? Particularly, the context is on the liquidity part, because on many base metals, the OI and volumes are not significantly attractive enough for several institutions to come and participate. So what's your take on institutional participation in the Indian base metals futures market as of today? Mr. Rege.
Right. I mean, see, in terms of, in the most of the presentation, I explained that we have already gone through the entire cycle of conversion, and the flow of goods, whether in, coming in or going out, has been pretty good, pretty hefty, I would say, and it's very consistent. So my belief is that their entry or exit, as long as they are willing to be participating on the deliveries and these things, shouldn't be a problem at all, because in terms of participation, depth, and all of this, we have seen contracts doing far better. And I'm sure moment a fresh pool of liquidity comes in, there is enough players sitting on the sidelines to participate and this thing. And if they are going to take the participation to the extent of making or taking delivery, I am sure the entire years of experience with us, it would be pretty seamless. In fact, not only that, they've one taking clue from what Joyce had mentioned about she mentioned about that metal also eligible to be listed and could possibly be looked at. In fact, on on a conventional mode, on lead, we in fact already are thinking to empanel and get the domestic producers or brands to get on, because these are the times. I mean, the lot of slides which were shown are saying that there will be slowdown, and if the automotive sector faces what's likely to happen, then obviously all these producers and the secondary and the refined producers need a place where they can they need to, so they can hedge or can deliver, and we aiming to come to offer something good on those lines.
Right. I think that is all we have time for today. So with that, we come to the end of this wonderful webinar. Thank you all the speakers, Professor Verma, Ms. Joyce Zhang, and Mr. Chittaranjan Rege, for your time and for helping us understand and unravel the intricacies of the commodity markets in general and base metals market in particular, and the risks involved in this market. Thanks to all the participants for joining. We are indeed delighted at the large participation at today's webinar, and hope that you have enjoyed the deliberations. My request to all the participants is to send your comments in reply to a mail that you will receive tomorrow from MCX webinar. Lastly, I thank my colleagues at MCX and SMP Global Platts for their support in conducting today's webinar. Thank you all, and we shall see you soon. Goodbye. Yeah.
Thank you very much. Bye.
Bye-bye.
Thank you.
Bye.